Good afternoon, students. This is Dr. Ali with you again. And today I'm going to be talking about Chapter 5, specifically classified balance sheet. What does that mean? Classified balance sheet. And I'm here, I have my PowerPoints also, and I have the book over here handy at the same time. So I'm hoping that you will also have your textbook handy with you before we go over some of these concepts. Okay, classified balance sheet means that, remember, earlier we learned about the balance sheet that on the left side we have the assets, and the assets are reported in order of liquidity. You start with current assets, cash, accounts receivable, prepaids, inventory, and so on. And then you have your long-term assets, property, plant, and equipment, and other assets. Yeah. So in a classified balance sheet, when you look at the balance sheet, you will see it in different categories, in different classes, okay, and subtitles. It has subtitles in it. Assets, for example, is divided into four categories. Okay, assets divided into four categories. Current assets, number one. Number two, investments. Number three, property, plant, and equipment. And the fourth is intangible assets. Four categories. Again, assets are classified into four categories: current assets, investment, property, plant, and equipment, and intangible assets. So four categories. That's what we say classified balance sheet. That means the different elements of the balance sheets are divided into different categories. Yeah. And these categories are listed in order of liquidity, ease and quickness of changing an asset into cash. Notice the first category is current assets. Those are the assets that are expected to be used within or consumed within a year or operating cycle, whichever is longer. So that's what current assets. And then you have the assets that are less liquid. That means it takes a longer time to change into cash quickly and easily without significant economic loss. So the first one is current assets, okay? And some companies group investment, intangible assets, and other miscellaneous assets into a category called other assets. So when you see other assets, when you look at the balance sheet of some of the corporations and you see category other assets, that could be assets that we didn't mention. It could be intangible assets, okay, like that. Yeah. Let me show you a category, okay, in page 176 of your textbook, Exhibit 3, 176 of your textbook, Exhibit 3. You see, this is a classified balance sheet. This is a classified balance sheet, and the first category is current assets. The first category is current assets. And there are a list of those current assets, okay? Current assets include cash and other assets that a company can reasonably expect to convert into cash, sell or consume within a year or operating cycle, okay? Whichever is longer. So current assets category includes cash, short-term investment, notes and accounts receivable, inventory, prepaid, prepays, and other assets. Yeah, other current assets. All right. If we cash, we know cash. I'm going through the list in Exhibit 3. I'm going on the. That's why you see me looking on the side, because I'm looking at this list, the current assets category. Current assets, those are the items, yeah. And so the first category under current assets is cash. We know cash is the most liquid assets. It's cash. It doesn't need time to transfer into cash. Then we have notes receivable and accounts receivable. What's the difference between notes receivable and accounts receivable? Remember earlier in the previous recordings, we mentioned that notes receivable is a promissory note. Okay, and it's and instead of when you do business with some people and you want to make sure that they're going to give you back your money, you make them sign a note that they will pay you within a short period what they owe you as a result of doing business plus interest. Okay, notes receivable can be both current assets and long-term assets. It depends on the period of time, the maturity date of it. If it is mature within a year, if that person is supposed to pay you the money within a year or operating cycle, whichever is longer, that's a current assets. That's the note. So the note has a specific period and it has interest too. So when you collect your money, you collect the principal and the interest. Accounts payable does not have a limited time and it does not have a interest in it. Yeah, it's just like when the vendors, if you ever worked in those convenience stores or in some other businesses, when the vendors come and deliver the merchandise to the store and leave the receipt, okay, that means the owner of the receipt is a liability from the point of view of the owner of the receipt, the owner of the merchandise or the store. From the point of view of the store, it's a current liability, but from the point of view of the vendor, it is a receivable. It's accounts receivable. All right. There is no time or date for the payment, specific time or date. So that's the notes and accounts receivable. Before those, short-term investment is a current asset. Short-term investment that comes after cash. Okay, it depends on if I am buying shares of stocks and I intend to hold those shares of stocks for a period within a year or less than a year period, is considered a short-term investment. So if I'm holding a security that I intend, a security means either a share of a stock, a bond certificate, so that's called a treasury bill, CD, all of those means the security. They call them financial instruments or securities. Okay, so if I'm holding a security and I intend to hold it for a year or less, it's considered a short-term investment. If I'm holding an assets for the purposes of using it in the future, okay, for over a year, that's a long-term investment. Therefore, it will be located in the long-term assets category. Okay, so these are, and then you have the inventory is a current assets, and then you have a, how do you come up with your inventory, and how do you record your inventory? We're going to have a chapter coming soon about inventory valuation. We have several methods that we're gonna learn: first in, first out, last in, first out, specific identification, and average method. We're going to learn those. So we'll use one of those methods to figure out your inventory. Or I'm sure you probably worked in some stores where they do come and look all the items of the shelves and record their value at cost at that time. That is the inventory. And then you have the items like prepaids. Those are like if you have prepaid insurance, prepaid rent, like that. Supplies is also considered a prepaid also. So that is the current assets. That's the first category. Okay, that's when we say classified balance sheet, mean the components are listed in categories. So the four assets, the first category is current assets. And like we said, under current assets, we have cash, short-term investment, notes receivable, accounts receivable, merchandise inventory, prepaid insurance, supplies. And then you total those, okay? And that will give you a total current assets. And I'm looking over here on the exhibit again. Notice that the first category here, that is your current assets. Now we're going to move into the next category in the bold letters, okay? And that is investment. So what's the difference between this investment and the short term? This is if you have an asset and that you are holding it for a period for more than a year. In this case, the book is saying there's a land held for future use. A land held for future use. That's why it is in the long-term section, in the long-term category, because it's going to be used in the future for a period over a year. And then we have the third category is property, plant, and equipment. Property, plant, and equipment. That is we through with first the current. We list all the current. We said again that those are the assets that you expect to use within a year or operating cycle, whichever is longer. You list them and you total them. Then comes investment, long-term investment. You may have land, you may have equipment that you're going to use in the future. You may have a house you're going to use or a store is going to use for business purposes in the future. You list that as a separate category. And then the third category is property, plant, and equipment. When we say property, plant, and equipment, we're referring to land, building, and equipment. Land, building, which one is easy to turn into cash comes first. So we start with land. Land does not depreciate. Okay, just be aware, land does not depreciate, therefore it will not have a accumulated depreciation. Okay, because these assets have supposed to be listed based on the cost, original cost. Okay, to fulfill the cost assumption, assets are recorded at the original cost in which they were purchased. Historical cost assumption. That means the assets are listed at their original costs when they were originally purchased. Of course, you're going to record it at the book value. That means you're going to list land. Since land does not depreciate, we just put immediately the value of the land when we purchased it. Then the building. The building does depreciate. Okay, the building does depreciate. Therefore, you're going to say building. If it cost you $50,000, you're going to say building $50,000 less or minus accumulated depreciation building. Whatever the depreciation, how much the building was depreciated from the date of purchase until today. That is that you're going to record that. going to say the original cost minus accumulated depreciation. It gives us the book value. So assets are recorded at their book value. Okay, assets are recorded at their book value. The original cost minus accumulated depreciation. And we're going to learn how to figure out depreciation in a different chapter. Hopefully, it's coming soon. Depreciation methods. We are going to learn straight line method, double declining or declining methods, production methods. We're going to learn those methods hopefully very soon. Methods of depreciation. And then you have equipment, the same thing like building. Equipment, you list equipment, list accumulated depreciation equipment, it will give you the book value of the equipment. So for the building, you have to record it at its book value. The equipment, you have to record it also at its book value. That means you got to list the original cost and the accumulated depreciation. You all with me this time? Okay, so let me show you again how they are recorded on exhibit 3. Exhibit 3, page 176. Exhibit 3, page 176. First thing, we did current assets. You see that on the top, current assets, we listed them. Then investment. Then the third category is property, plant, and equipment. Notice the land does not depreciate. So immediately you report it at its original value. And then you have the building. Okay. Notice the building. Building is 82,600. That's the original cost of the building. And then less, notice here, less accumulated depreciation building, 34,560. Okay, and then it gives us the, here you have the final values. This is the book value of the building. And the same thing for equipment. Okay, the original cost of the equipment, less accumulated depreciation equipment, and give you the book value of the equipment. Okay. All right. So that's how you should list the third category. And the fourth category of assets is the intangible assets. Okay. The intangible assets. Those are the assets that have economic value, huge, it has a big economic value, but you cannot touch and see, such as trademarks, copyrights, trademarks like, for example, and the different logos like Nike, like franchises like McDonald's. Not anyone can go and just build a restaurant and put on it McDonald's. You have to have permission. You have to have permission. That's a trademark of a McDonald's. And the same thing, you cannot just go and make shoes and put on it Nike. Okay, that's a trademark of Nike, of Nike. Okay. So those are, you list those in the fourth category, intangible assets, and then you total the assets. Okay, total current assets, total investment, total property, plant, and equipment, and total intangible assets. That will give you your total assets. Okay. Then we come to liabilities. Same thing. We start with current liabilities and then long-term liabilities, and we add them. Okay. I'm going to show you in the exhibit again. Notice in the exhibit, liabilities start with current and then long term. These are your current liabilities and these are your long-term liabilities. Okay, liabilities is your obligations obligation for other people that you're supposed to pay off from your assets. Okay, obligations against your assets. That's what you owe to other people and entities as a result of doing business with them. So there are things you owe that you have to pay within a year, and there are things that you have to pay within long time. Okay, accounts payable and notes payable, those are current liabilities. Those are expected to be paid within a year or operating cycle, whichever is longer. Okay, now again, the accounts payable and notes payable are the flip side of the accounts receivable and notes receivable. Like I mentioned earlier, if you work in a store and then the vendor come and fill up the shelf and leave a receipt. So for the store has accounts payable. Okay, the store is obligated to pay what he owes to that vendor or that merchant. However, if the vendor made the store, he doesn't trust the store manager and said, sign a note for me that you're going to pay me within 60 days plus interest. At that point, it becomes a note payable for the store manager and notes receivable for the vendor. Okay, so again, in current liabilities, you have accounts payable, notes payable, anything payable within a year, you got to list it. So you could have accounts payable, notes payable, salaries payable, utilities payable, taxes payable. All of those, if you have them, you will list them in the current liabilities category. Okay, and then you have your long-term liabilities. Okay, the long-term liabilities, guys, for example, the note payable. If it is to be paid within over a year, it becomes a long-term liability. Okay, the deciding factor is the period of payment. If you have to pay the note within a year, it's current. If you have to pay the note within more than a year, it becomes a long-term liability. In accounting too, hopefully you guys are have to pass accounting 1, and so far I am not encouraged because you guys did not do problem 4, problem 10 in chapter 4. It's a course requirement. Okay, it's a course, you have to do it. Okay, chapter 4, problem 10 is a course requirement. You have to do it. It may hinder your passing accounting 1. Okay. So long term, we have liability that we're going to learn in accounting 2, especially the bonds payable, BONDS, bonds. Okay, some people think I'm saying bonds. It's bond, BOND, bonds payable. That is a long-term liability. Okay, before we learn the bonds payable, we're going to learn the time value of money. And also mortgage. Okay, house mortgages, car notes, those are all long-term liabilities. Okay, and then comes the what's left for the balance sheet. Remember, assets equal liabilities plus owner's equity. Okay, in accounting 2, we're going to learn, and instead of saying owner's equity, we're going to say stockholders' equity. Okay, it depends. because the owners of the business are going to be whoever owns a share of the business is partially owner. Okay, but in this case, when we talk about partnership, proprietorship, sole proprietorship, and partnership, we're talking about owner's capital. Okay, so owner's equity, remember, guys, you all did exercises where you have to do first the income statement, then you got to do owner's equity and balance sheet. So before you come to owner's equity, you have to do income statement, and then you do the owner's equity. Remember owner's equity formula, start with your beginning balance when you start the business plus net income. That's why you need to do income statement first. Beginning balance plus net income plus additional investment, if any, minus withdrawals will give you your ending balance of capital, and that is the one you want to put in the balance sheet. Okay, so that's, guys, why it is called classified balance sheet, because the categories of the balance sheet are divided into different categories and classes. Different classes. Like we said, we started with assets. First, we listed current assets, and then we specify what are those current assets, and we total them. That give you total current assets. Then comes your investment, and that is the on the long-term period. Like if you have a land held for future use, if you have a house or equipment you intend to use for the future, or if you have some kind of an investment, even in stocks and bonds, and you intend to hold those for a few years, it becomes a long-term investment. And then it comes your property, plant, and equipment. Okay, you start with the land. Now remember, the land does not depreciate, so you immediately put the value of the land. And then property, plant, and equipment, then you have your building. Building has to be reported at its book value. That means the original cost minus accumulated depreciation. And you have to include both. When you report the balance sheet, you have to record both on the balance sheet. The original cost of the building. Let's say you purchase it for 50,000. Let's accumulate depreciation. If it was depreciated for $4,000, so 50 minus 3, so that will be 47, the net value of the building. Equipment, the same thing. Equipment, original cost less accumulated depreciation. All right, and then you have your intangible assets. So if you don't have any intangible assets, you don't have to record it. Yeah. So, but you record all the assets that you have within your organization, within your business. Okay, then the next, then you total all your assets. Okay, you total all your assets. Then you come to the next part of the right side of the formula. Remember, assets equal liabilities. So you have to report liabilities then and owner's equity. So your liabilities, you start with your current liabilities. Those are the obligation on you as a result of doing business, what you owe other people. You start with the liabilities that you have to pay within a year or operating cycles, such as accounts payable, notes payable, salaries payable, taxes payable, okay, all of those. And then you list them and you total them. Then comes the next category of your liabilities, long-term liabilities. Those are such as car notes, mortgages, bonds payable, okay? We're going to study in accounting too. And then you put the value of those. Uh-oh, somebody is calling me. And okay, I will respond to that later, yeah. And then comes owner's equity. Like I said earlier, you have to do your income statement first, and then you come to your owner's equity. That's the one, beginning balance plus net income plus additional investment, if any, minus withdrawal. give you the ending balance, and that's the one you put in the balance sheet. Okay, that is the classified balance sheet, and I hope that I explained it to you clearly. And let me see if there's anything else that I have to mention here. I think I am okay here. You can do the rest of the chapter on your own. I just now, why do we have classified? Why do we have classes of the or different categories of the components of the balance sheet? Okay, by the way, income statement also, we're going to come to that multi-step income statements, not just revenue minus expenses. Okay, we're going to come to that later. Yeah, but for now, why do we have classes like that? Why do we do a balance sheet into different classes like this? Okay, again, this is a page 176 of your textbook, exhibit 3. Please go to that and read and get familiar with how the classified balance sheet look like. It's going to be easier for us to do our analysis. That's why we need these classes to do our analysis of the financial statement. In accounting 2, we have a project that we have to do analysis of the financial statements. So, for example, if we want to know the liquidity in a business, okay, how do you, because you got to look at that, these multi-step financial statements, the balance sheet and income statement. You need both of those in a multi-step fashion so you can easily do your analysis. Okay, for example, liquidity. Okay, what is liquidity? Liquidity means the ease and quickness of changing an asset into cash. Do you have in the business enough liquidity? Do you have enough of those assets that you can convert into cash within a short period without significant economic loss, or in economically reasonable fashion? You change these assets. Do you have enough of those? Well, somebody, if I want to give you a loan for your business, I got to make sure that you are able to pay me back. So that's one thing I look at, the liquidity in your business. It's equal to current assets divided by current liabilities. It gives us how much. We're going to do that in accounting too, but now I'll just mention it briefly. And also, if I want, what is your working capital? What is the working capital means is the excess of current assets over your current liabilities. After you pay off your obligation, what you have, after you pay your salary, you pay for your supplies, you pay your taxes, you pay your rent, those are the dues that you have to pay within a year. After you pay them, do you have enough? Do you have idle cash? That's why you need this classified balance sheet. Okay. And I think I am going. And also you can look at the profitability, the ability of the business to generate business. That's why you're going to be needing these different classes. That's why you need this classified balance sheet and multi-step income statement. Okay? You're going to judge in, and then you're going to look at your assets turnover, how effective your assets are. Are they working properly and generating enough revenue for you? And then your ability to survive. Okay, your ability to survive. Debt to equity ratio. You're going to look at that. Are your equity returning enough revenue for you? The equity you invested in the business, so you're going to look at return on equity. So that's why you need these classified financial statements. All right, again, make sure you look at page 176, and the details are in the pages that follow. Like I said, if you don't have the book, I've taught accounting 21 years and I'm still going back to the book. So I expect every one of you guys to have the book if you're really interested in learning. Okay, I can't imagine an accounting student and doesn't have a textbook. Okay, because this book also is an investment for accounting 2 also. So you are buying one book for 2 courses. Just make sure you buy the thick copy, the big copy, not the copy that has 11 or 12 chapters only in it. Okay, because you're gonna need the full volume for accounting 2 also. All right. Have a good day, everyone, and God bless you.